lot of time is being taken by the Series A and later investors in decision making. That's what we are hearing anecdotally. I'm sure some of these investors can a little bit more color. Angel is still now ticking down, right? So at least as far as 24 is concerned. So which cities, Bangalore, which rocketed up in 2021 the most and 22 as well, is actually still hurting, right? So NCR, Delhi and Mumbai has actually done better in terms of value, and if you look at the same in volume terms, the picture is no different. Mumbai is ticking up, NCR is already up, but Bangalore is still caught up with some of the legacy issues that again the panel can throw a little bit more light about. In terms of investors, a very, very interesting transition seems to be taking place. Again, something that I've put to the panel to talk about. There is far more domestic-led. The same table of most active investors, even 3 years back, would be dominated by Silicon Valley-sponsored funds, right? There are some names still here on Silicon Valley-sponsored funds, but they've changed their name. They are no longer the Silicon Valley-sponsored names at all. While, so that's happening as well, but enough domestic homegrown funds are leading the activity table, and that's very consistent in the last 2 years. And we did a report on the Series A stage. There also, not just the Series A investors themselves, but the ones driving the pipeline for the Series A investors is actually domestic, institutional money. I'm not talking angel or seed. This is domestic institutional VC investors. InfoEdge is, of course, now an AAF fund, but originally a strategic investor. Rainmatter Capital, we know their Zerodha connection. So these guys, DVC, for example, is a Z47, and there are folks from that fund in this room. They've sponsored this. So very new kind of formations are taking place. Very interesting. I am sure the panel will talk a bit more about this. So with this picture in terms of a changing landscape of VC investments, especially led by the IPOs and the excitement around the Zomatos and Swiggies and the Ola Electrics and the Mama Earths. Really looking forward to insights from this panel and what we can look forward to in 2025 and beyond. Thank you so much.
I would now like to call on stage the panelists of the Venture Capital View panel. Daryl NG, Vice President, HarbourVest Partners. Subeer Monga, Partner, Sorin Investments. Naganand Doraswamy, Managing Partner and Founder, Ideaspring Capital. Amish Dedhia, Principal, Chiratae Ventures. Mahima Narsaria, Investment Team, Brand Capital. Sumit Sinha, Partner, Phoenix Legal. Shabarish Seshadrinathan, Vice President, Basiz Fund Services. Lalit Valecha, Founding Partner, AVA Insights. First, I would like to introduce the moderator, Lalit Valecha, Founder Partner, AVA Insights. Lalit is a founder partner at AVA, an advisory firm based out of Pune with offices in Mumbai, Dubai, and Bangalore. Lalit heads the transaction advisory service practice at AVA. Lalit has worked on diverse engagement of global companies headquartered in various countries like USA, Germany, UAE, and Singapore. He plays an active role on the advisory board of Indian startups in SaaS B2B space. He has also worked with a lot of micro VC firms, including Better Capital and Multiply Ventures. Before founding AVA in 2005, Lalit was in the assurance group of the PwC Pune office. Lalit is a practicing chartered accountant since 2005. He received a bachelor's degree in commerce from the University of Pune in 2001. He also holds a certification in financial modeling from the NSE Academy and is an associate member of the CPA Australia. Over to you, Lalit.
Thank you, Arun. Thank you for having me out here as a moderator. This is the second time I'm doing this. And I think it's a very interesting panel that we have out here. There are two lawyers that are sitting out here. One lawyer who's actually pivoted from being a lawyer to become an investment banker on herself. People from the VC, they have GPs in VC firms. Somebody who manages fund management global across various geographies. So it's actually a mixed bag, and I think we have some LP as well. So it's a mixed bag from an overall perspective. What we're trying to cover out here, and I think Arun's slide put some light to it, is we're going to look at maybe starting from a seed stage investment to what a seed stage investment looks like when some companies, like we're already seeing a lot of IPOs that are happening, and when there is investments happening, how does that landscape play out? We saw a few companies out there like Zepto. They're coming back, like Ghar Wapsi is what commonly is known as. Like a lot of these companies went outside, thought there's capital outside, wanted to raise, maybe Zepto went in Singapore, raised in Singapore, but wants to come back because of an IPO in India. That's the primary reason. So I think that'd be the background. Before I think we start, I would want each of the panel members just to do a short intro about themselves, and then maybe I can start with the questions. Yes, sir.
It's actually great to be here at the Venture Intelligence event. I've been with Basiz for about 8 years, and I have attended, multiple Venture Intelligence summits as more as an audience, because our founder and managing director used to be speaking and moderating at these events. It feels great to be sort of taking stage today, and I thank my board also to Venture Intelligence. A huge round of thanks. I've been here 8 years in the fund administration space, out of which 4 years I've been corely into operations, and then transitioned more into a business development role. Because what we believe in Basiz is that when we go to meet clients, we try to give solutions. So that pretty much happens in probably the first or second meeting. And that's how I was transitioned into a business development role. And prior to that, I spent about 4 years in KPMG in the assurance side. And all the accounting, auditing, and financial reporting experience clubbed with the AIF growth around 2016-17 brought me to Basiz in 2017, and since then I've been here. So thank you so much.
Hi, I'm Sumit Sinha. I'm a partner with Phoenix Legal. It's a pleasure to be here and be participating in this panel. We are a full service firm. We provide end-to-end legal services on almost all areas and aspects of law. I personally am an M&A and private equity venture capital lawyer. I've been fairly active in the venture capital transactional space for the last couple of years, and I've been actively working with some of the funds and making their investments and helping them with their exits. Thank you.
Hi, I'm Mahima from Brand Capital, the investment team, the strategic investment arm of the Times of India Group. Personally, I started my career as a corporate lawyer with Khaitan & Company, then moved to the investment team at Brand Capital. Since then, been focusing on investments in companies that require, consumer-facing companies that require the marketing capital that we provide. So look forward to meeting you all, and thanks to the team at Brand Capital for this opportunity.
Hi everyone, Amish Dedhia here. Thank you VI for this opportunity. I work with Chiratae Ventures, which is the largest domestic VC in India with 1.3 billion AUM. What I focus on is helping our portfolio in growth and exits. So helping them raise capital and eventually ensuring that they can provide us returns, and it could be by way of IPOs, M&As, or secondaries. So that's my niche role here. Thanks.
Hi, thanks Arun for having us here, and we have been, as a venture capital fund, using venture intelligence data quite a bit, and appreciate all the help you provide to the industry. Started Ideaspring Capital 2016, post my entrepreneurial journey. We are starting the third fund now. We've invested in 31 companies, all pre-revenue seed companies focused in science and tech. So typically hence translates to B2B and B2B2C, and all typically all India domiciled startups, because we are early stage, like to stay closer to the founders, and that's been our focus.
Hi, good afternoon everybody. I'm Subeer Monga from Sorin Investments. Ashok, Arun, thank you so much for having me here. At Sorin, we are a Series A, Series B focused fund. We're a 1350 crore fund, new kid on the block. We've made about 6 investments so far, a few more in the pipeline, and hopefully a lot more to come.
Hi everyone, my name is Daryl, and thanks to the Venture Intelligence team for having me here today. I'm from HarbourVest, and we are a global private markets solutions provider, and we have invested in funds, secondaries, and co-investments for over 40 years now. We have about 220 investment professionals, constantly building relationships with and evaluating partnerships with GPs globally. And today we manage in excess of $130 billion in AUM. With regards to India, we've invested in this market for close to 20 years now, so I've really seen the cycles and the ups and downs. And today, I think India is very much part of the growth story that we try to deliver to our clients in a globally diversified portfolio. So very happy to be here. Thank you.
Thank you, everyone. Yeah, thank you, everyone. I think I'll start with Daryl first. I think we've taken a view of, I think the earlier session also focused on how India is growing. I think the slides also that were there. So I would just want to take a view from an LP's perspective where international portfolio is also being looked at, not just India focused. So I think Daryl, from your perspective, how do you see the Indian VC landscape that's been progressed over a while? And how do you compare that when you compare to some markets like say China or Southeast Asia? I think that you have some deployment there also. So if you can compare that, and do give us your thoughts in terms of how does that compare?
No, thanks, Lalit. Happy to start here. So I think overall, I would say that we've seen a very positive evolution of the India VC market, right? I think we've been, maybe for context, we've been investing in India VC funds for over a decade now, and I think going back to the early days, there's always been a lot of potential from growth, disruption, innovation, evolving demographics. Lots of potential, right, that we've gotten used to hearing about the India story. And I think if you think about our experience investing in India VC, in the earliest vintage of funds, we've seen some very large outcomes that have been produced today and exited, either through strategic M&A or on the public markets that we've seen in the last couple of years. I think, however, in those vintages, and I'm specifically referring to maybe up to 2010 to 2012, due to some market friction, scaling of companies took slightly longer time, exit markets was less mature. We've seen the outcomes being delivered on an absolute basis, but I think there were some challenges to seeing how it could be delivered in the typical 10-year fund construct. But I think fast forward to today, there's been very positive developments on these fronts, right? I think we saw the introduction and development of the India stack. We saw kind of founder quality improving, venture GP qualities and depth of the market deepening as well. And even post more recently the 2021 peak of the market, you hear and see a lot of founders being more focused on growing sustainably, positive unit economics, and all of these bodes well for the maturity of the market, right? So I think there is a case to be made for a positive trajectory of India going forward that that we are very much heartened by, in covering the region. Now, I think with respect to how this India VC plays a role in our broader portfolio, I mean I'll paint an India view versus a global view, right? I think for us, global LPs, we originally came to India, for us, it's been the early 2000s, originally via private equity managers, and then maybe later on in venture. I think at the end of the day, we construct our portfolio and look at it really on a risk-return perspective, right? I think private equity has had the potential to deliver good outcomes for us at earlier liquidity points than venture. But I think as the venture market has developed and deepened, as I mentioned earlier, I think there is a growing case to be made for exposure to disruptive technology and new age companies within our India portfolio. And we've continued to do that. I think with regards to how it compares to other markets, I'll maybe draw a comparison to the two other global large markets for venture, US and China, because that's really kind of the benchmark. I think for us, we build globally diversified portfolios for our clients. And I think India is really on the uptrend where I think the number of outcomes or the size of the outcomes that you see is still maybe some ways behind some of these larger markets. And in approaching the portfolio construction for us in India, we like to back managers who are well positioned in the respective sectors that they pursue, are sensible around fund sizes, the rounds they enter, valuations, and the like, that at a fund level, it makes sense to deliver that alpha, right? That we frankly underwrite when we invest in a market like India.
Thank you, Daryl. I think I'll move to Subhashish. A valid question out here that I would want to pose to him is, while we look at the global investments that I think we just mentioned, the Indian market, there are a lot of VCs who also look at an outside India presence. I think from that perspective, how do we compare maybe setting up some global jurisdiction, like Shabarish, you mentioned that you manage some of the admin funds which are in Singapore, or also how do you compare it, the GIFT City one that's coming up. So I think the buzzword, a lot of things have been done in the GIFT City, how it's progressed, a lot of tax benefits have been given to the GIFT City in that sense. So how do you see that interplay, and how has been your experience in that sector?
I think this question or this topic has been quite a talk of town, and rightly so. It's grabbed everyone's attention. Also, this question is very close to our sort of scheme of things in Basiz, because I don't know how many members in the audience know this, but we were betting on the Indian story almost since 2008, 2009, when really fund administration was not a concept in India. And we have been a very early backer of GIFT as well. So we opened our GIFT office in 2019, before the second regime of the current central government. And we have been there. I think our founder was there on multiple of those meetings, initial meetings, and many of his suggestions went into the making of the IFSCA law as well as the FME law. For example, the whole idea to regulate the FME instead of regulating the fund as is done in domestic market was his idea. So to answer this whole question as to domicile preferences or how funds are being domiciled across the globe, we need to sort of reverse the clock 10 years and 2 years further before from there. So if you go back to 2012, that's when the AIF law came into picture. And the beauty with the AIF law, 2012 law, is it set a very strong foundation for funds and multiple structures to be set up within India. And that foundation started gaining traction by around 2015, when you saw a decent number of India-focused funds being set up in India, as opposed to being set up from Mauritius, Singapore, and Cayman. I mean, somewhere between 2014-19, Mauritius used to account for I think 50% of the India-focused funds, Singapore another 30% and 20% between Cayman and Delaware. That is the history that we're talking about. Then if you roll forward the clock to about somewhere between 2016 and 18, so 2015, the funds which were launched in 2012 under the new regime had started seeing their first close getting done, deployment happening. And between 2016 and 18, a lot of consolidation happened. And this consolidation happened because of multiple sort of reasons, right? The first reason that we can identify looking back today is that India went ahead and amended its DTAs with Singapore and Mauritius. So that was one very big sort of thing that happened. Secondly, the compliance requirements in Singapore and Mauritius also went up. And that sort of had an impact on the speed at which licenses were being issued in those two domiciles. And by 2017-18, SEBI had spent about 5 to 6 years sort of regulating AIFs, and hence they also caught up with the speed of the MAS and the FSC. So this was the whole phase that happened between 2016 and 18. And this pretty much continued. Then of course, GIFT came on the block, and GIFT sort of revolutionized multiple things, because earlier, though the SEBI had caught up with the MAS and the FSC in terms of regulation and in terms of licensing speed, one thing that remained open was the tax efficiency that sort of GIFT has plugged in right now. India is and was and continues to be on par with Singapore and Cayman and Mauritius today in terms of tax. And I think GIFT is really revolutionizing a lot of things, because for the first time, so our firm has been in the business for 20 years, our founder has been in the business for close to 30 years. So when he started his career, Cayman, Singapore were not even names. What was happening was the ABC Islands. I don't know how many people know the ABC Islands, Antigua, Bonaire and Curacao. So we have seen that cycle, right? And GIFT has really taken a revolutionary step, because they are sort of regulating the funds in the true sense. So if you look at presence or substance, for example, in GIFT, it is not just about paperwork. Substance actually has to be proven on ground over there. It goes much beyond paperwork, which I think is very good news. I know it causes a lot of disruption in the environment, but it is good news, because it sets a very strong foundation where they expect you to do good business over there with actual KMPs and being able to prove POIM from there. So that's great. As far as GIFT is concerned. So that consolidation has also happened. The last trend that we have seen over, since 2021, when IFSCA came into its own, was from 21 till about mid-2023. GIFT was, broadly speaking, a domicile for inbound funds into India, which basically means feeder funds and not very actively managed funds. Now that has also changed. Probably in the last 12 to 15 months, I would think the last quarter of calendar year 2023 till today, the number of active funds in GIFT have also increased, which is great news. And there's a lot of outbound activity also happening right now. So that is good. And for me, there are three positives and two things that I look forward to from GIFT, to sort of summarize this whole, this question of domiciling. Three things that have worked greatly for GIFT. One is the fact that the regulator is omnibus. SEZ has also been brought into, into the ambit of IFSCA. Though there is still a lag in the sense that, the form and the compliances for SEZ are still separate. It's not being harmonized with IFSCA, the actual IFSCA reporting that happens. I think that will happen in the next few quarters. The second thing that has worked, very well for GIFT is the fact that grandfathering has been allowed. So a lot of funds are now moving their legacy entities from Mauritius and Singapore to GIFT. And because grandfathering is allowed, the performance track record does not allow. So that's another very big sort of boon for GIFT. The two things that I think everyone is looking forward to as far as GIFT is concerned is first an alternative to SWIFT. Because what happens is foreign money comes into GIFT, then there's one GIFT USD account, and then there needs to, just to move the money from one GIFT account to another GIFT account, you need to go through the SWIFT code, which is, takes some time. Again, it causes problems for Cat3, it causes a lot of disruption because within a day the NAV can fluctuate a lot, especially in this kind of a market. Last but not the least, I think one thing that I know the regulators, both at the GIFT level as well as at the central government level, people are working at is the VCC, VCC regulation over there. Now, if you look at us in GIFT, we have already applied for an FME license. Why would a fund administrator apply for an FME license? Because we have seen, so we have offices in Mauritius, and we see how platforms are set up over there. Now, if you look at the trust and scheme mechanism that's there in India, you really don't need VCC because the trust has its own identity and the scheme has its own identity. But for some reasons best known to the regulators in GIFT, they have, though we tried to pitch for the platform idea, they are not yet very friendly to it. And I think VCC regulation can to a large extent solve that problem. So this is the whole domiciling preference or the domiciling picture that we currently see.
And I think you're right. The VCC structure that you spoke about, and I think the SEBI regulation in itself, I have been advising a lot of clients, and many times when they compare Singapore or even US, they prefer an outside India jurisdiction than be in GIFT City because of the pure sheer regulatory reporting requirement that's coming over. I think Sumit, over to you. What's been your take on the domicile of a fund?
No, in a lot of ways. In a lot of ways, I would agree with what Shabarish was saying, but couple of things in terms of GIFT which become relevant and maybe important from a fund perspective to be really kept in mind is the fact that for Indian investors, GIFT is still an ODI/OPI/LRS investment. So that depending on where your LPs are located and what kind of capital you're trying to access, I think GIFT vis-a-vis a regular SEBI regulated AIF becomes a deciding factor. But definitely one of the benefits that you would get in setting up in GIFT is that you have access to overseas market, which unfortunately SEBI AIFs cannot do. And it goes through a regulatory approval process, which is both time consuming and it sort of delays and it's not very cost effective. Of course, you'll then look at alternate structures, etc., which again are not very kosher, and then you want to rather be invested outside. So you do end up going through the regulatory approval process. So yeah, while GIFT is a significant development and it's an important alternative to setting up a fund outside India, both in terms of solving, like Shabarish said, the poem issue, because we are actually setting up an office there, there is substance to that extent, and of course raising capital from investors outside India. Investors are also more, foreign investors are more comfortable because if you don't have any other domestic income, then you don't really need to have any sort of interface with the Indian Income Tax Department. So to that extent, yes, it's a great alternative, but yeah, there are still some loops that we need to still cover, both in terms of regulatory updates and ease of doing business in the gift.
I agree, like what you rightly mentioned, the FEMA regulation in itself, because a gift city fund, if it is, the GP is an Indian GP and the LPs are Indians, again, the money can't come back to India. It has to be an outbound employment. It can be a Mauritius fund which can go to a gift city, not an Indian fund that can domicile out there. Indian fund domiciling out there means an outbound investment. So I think you're right out there. I'll take a different, I think, diverge out here. We've been speaking about, I think, growth capital, maybe IPOs. I would just come to an early stage investment. I think one of the slides that Arun just presented in terms of what we saw, the numbers out there, DEVC, which is obviously sponsored by Z47. What we look at is a lot of these, I think the VCs getting into early stage investment at the seed level, the seed investment funds. Chiratae also has their early stage investment funds. I was just speaking to Subeer also. He had a different view on early stage investment. So I think I would ask the questions to the VC panelists, starting from Naganand, then I think Amish can pitch in, and Subeer as well. So Naganand, over to you. How do you see the early stage investments where most of these funds are setting up for seed investments? How do you see that interplay coming over?
So I think if you look at the startups, like in the slides, there is some stagnation in the past 2 years, but if you compare anything with 21 and 22, everything looks like stagnation, right? But when you actually doing investments, we have been quite, it's been reasonably okay from our perspective in terms of trying to find startups and invest in them. And we do only four or five startups a year, so for us, from our own fund perspective, we have not had any serious challenges in early stage seed investments. However, when we do Series A, since I do only tech and science, I think that has been a challenge, because I think that particular ecosystem in India is still in the very early stages compared to B2C. When you look at focused tech, deep tech, what we call, or science, the early stage investments is there, but I think the later stage investments are still not there. Only because, like, I look at any ecosystem in three legs, right? There's a market leg, there's a talent leg, and there's a capital leg. I think both talent and capital is still question mark, and market in India is still not very, very mature for those things. So I think, from a deep tech perspective, we are all figuring out how to make forward progress. There's a lot of promise, but a lot more work to be done. But I think B2C and D2C is a lot more mature in the Indian market. And with the IPOs that are happening in the industry, I think you'll see a quick revival. I think HarbourVest also must be seeing through their funds. But since my focus is mostly on tech and science investments, early stages are okay, but the later stages are where some challenges do exist at this point of time.
Same question? Okay. So I think as far as seed investing is concerned, volume shot up a lot over the last 2 or 3 years. I think as we saw from the chart earlier today, there has been a little bit of control, I would like to believe, that's come in, and a little bit of sanity too in terms of pricing. You always have outliers out there, but I think a lot of it has got to do with the underlying businesses itself. I think in the COVID period, we had a lot of free capital floating around in the ZERP era, and therefore there was a lot of capital which could solve for a lot of expensive cost of customer acquisition. As interest rates have moved up, that capital has gotten expensive, and there is an expectation of, how would I call it, ROI on dollars spent. And I think a lot of that reality is starting to set in the ecosystem. That is visible, forget on the early stage side, it is visible even on the later stage side, right? As companies are going public today on the later stage side, a lot of that is flowing through downward, where there is a lot of pressure on companies to become profitable. And therefore balancing that delta between growth and profitability. So I think this is a journey. There has been so much action in India, but if you really think about it, at least contemporary venture capital in India started when, let's say, Flipkart got its first check, right? Which was 2010-11 in that era. And if we take a step back, it's been 15 years since this venture industry has been around. 15 years is not even an adult in the grand scheme of things. Whereas if you go back to, let's say, the US industry, it's been around for 70 years, right? It's gained wisdom, to say the least. And therefore, to your point, I think as the ecosystem grows over a period of time, a lot of maturity will continue to grow into the ecosystem. So we'll see a lot of good things coming out. We just have to play through the cycles, I guess.
I think I'll try to cover something different here, slightly different. On the seed side, I think India is witnessing a lot of activity. Of course, 21, then 22, 23, and now slight up, okay? I mean, if there was one deal a day, then it went down to one deal a month. It's now come to, I think, let's say 3 deals a month. I mean, of course, odd stats, nothing justified, but just saying that momentum is there. And most of the VCs have the money right now. They were sitting on it last 2 odd years. There was hardly any. That winter phenomena continued, extended. So there is investing which is happening now. There are a lot of ideas. Like a fund like us would see at least, I think, close to 4,000 to 5,000 ideas a year at minimum. Okay. And then of course we go through our own journey, because in every fund, every new fund, we keep a reserve of at least 10% for seed. Okay, 10% odd. And we understand that only 30% of it will go to A. We already know that. Okay. But if we are not taking enough risk as a VC to support ideas, to support entrepreneurship, then I don't think we are doing our job. So we work with that ethos, and I wanted to make it, slightly loud and clear here, because as Subeer rightly said, we've just become adult now. We become 18. So at Chiratae, but from our side, this experience has helped us, craft this thought process that let's keep the 10% of every fund for seed. Let 70% of them go. It's okay. Maybe these founders will come back by the time we have a next fund, and maybe they have those learnings so we can back them again. And we like failed founders also, okay? So here the idea is to evangelize entrepreneurship a lot more. And within seed, many of us, like I think you alluded to the fact that we have a program, we call it Sonic. And other funds have their own specific programs, or some of them are dedicated programs which run as cohorts. Some of us have these are means or initiatives to attract ideas for us. And with a lot of government support and stuff, today we are trying to promote it. Like for example, we had like 4 roadshows in UP this year, okay, through our new fund. Not only did the government ask us, but it was our initiative also, that go to areas which people would have not thought. Otherwise, what's your typical thought process? Bangalore, Hyderabad, NCR, Chennai, okay, bas yahan se idea mil jayega, add west thoda bahut Bombay, but what more? Okay, so now going to UP, because that is where, and again we found ideas which have come at least to IC stage. They may not have cleared fair enough, but at least let's promote the idea. And hence most of us VCs are running these programs specifically. And the other way we do it is, not only do we run a branding exercise of this program, but we do tie-ups, okay, with all the IITs, with all these angel networks, with all incubators. And today we are seeing every sort of that institution happening, okay. We have one company called Unifor, which is a $1.5 billion valuation today. That company was founded in IIT Chennai, okay, through our partnership. We did a seed investment. You can imagine the upside we are sitting on in this particular investment. We came in with like, not even 1 million first check, and today the company is at this value. So ideas are there, we have to support them. And that's why we all like to tie up with as many networks. And today, one last point, I think a lot of family offices and professionals are now taking that, wearing that hat that in my free time or in my passion, I will try to do angel investments. So everybody has some play. So that is some level of evolution over the 15-year journey, 18-year journey today in India. And we are happy to partner with any such network so that ideas are welcome. Of course, we'll evaluate, we'll have our own hypothesis of how and where we invest. But at least welcoming ideas is something there. And I think a lot of activity back in the seed stage. Yeah.
I think a lot of startups who are there in this room can approach Amish after this meeting and see if he can put some investment in your company. But I think that's a right way to look at it. Support the startup at a very early stage and maybe double down where you see the growth and you see the aspiration, like the 1 million check that we just spoke about. I think quite a few can emerge in that sense. I'll take a different turn now. I go to Mahima. Would want to understand what do you do in brand equity, and I have a follow-on on that. But just because I think all are VC investors, we're talking different things. So how does brand equity add value to an investment? I saw the portfolio investment, 1,000 plus is what you've written out there. So would want to understand what brand equity. I think quite a few of we are aware, but you've changed the format, so if you can just throw light on that.
What we do at Brand Capital is that we partner with companies whose value is yet to be discovered. We want to be part of the risk journey of a company. Companies that are doing something disruptive, that are doing something for the first time, that requires shaping or changing of consumer behavior, educating the audience. I think that's where Brand Capital comes in. We partner with companies very early on. Our model, like I think Lalit mentioned, has seen a little bit of a change in terms of doing deals with very high quality companies, selective in our investments. We've been doing all of that. Our audience is a very discerning audience, decision makers who are, kind of reading our newspapers. So I think brands also require that to command the pricing power, the differentiation and the pricing power. We recently did a deal with India's first diamond company, Aura. We are doing deals with large business houses. We did a deal with True Native, it's an Emami and Rain Matter funded company. So we're doing deals in the D2C space. Of course, to say yes, we're sector agnostic, but companies that require some kind of changing of consumer behavior is where we come in.
Got it. And how have you seen the D2C market play out? Because I think most of the companies that come to you predominantly will be a D2C company, and D2C company specifically naming minimalistic. I think the exit that they got, Mamaearth getting IPO. So how do you see the landscape changing in the D2C segment itself? Because I think most of us invest in tech companies, I think most of the VCs out there. So how do you see the D2C? If you can just throw lights on that, and if there are other VCs who invest in D2C, I would just want to ask that also. How has the landscape changed from a mindset where we look at a great exit, an all-cash exit by HUL buying out at 3,000 crores, I think enormous 6x revenue valuation. We don't get that kind of valuation even when primaries happen. So I think, how do you look at that? And the IPO of Mamaearth also, I think the valuation they also got. So how does the landscape is evolving?
I feel like the D2C landscape is seeing a consolidation. What it's seeing, what the minimalist HUL deal did was that it validated the D2C exit story, where maybe exits would be a challenge. The founders got a lucrative exit. What also the D2C space is seeing is a lot of interest from FMCG companies like Emami and Marico's of the world. The landscape, like I think Subeer mentioned, we're a 20-year-old company, so just about an adult there, doing investments in the D2C space. It is a fairly mature industry, to say, of course, if you want to compare it to the deep tech AI industry, fairly mature industry. For brands, if you're building something differentiated, if you have a clear vision of what you're building, you have a clear path to your profitability and all of that, I think you can find a footing in the market. And I think deals like the Minimalist and the Mamaearth IPO, etc., are encouraging the market. Global trends also, like say Tacha being funded or Drunk Elephant being funded, is a testament to the maturing D2C industry and the consolidation in that industry.
Amish, any views on that?
So we've been more of a platform investor and not D2C, honestly. But today, the way the market is evolving, there is depth. I think I agree with her. Two of our brands, which are vertical commerce, have now become brands per se. Lenskart and First Cry. Today, we can call them D2C in some sense with their omni-channel presence and the power that the brands command today. But there is a big evolution. I think from D2C perspective, I was just talking to somebody in the afternoon, that reaching up to 100 crores of revenue, fair, people can, many of them can, because there is this whole online segment where you start your journey. There is innovation, there is something new that you're bringing on board, and you are able to command, those early movers who are digital first in terms of consumers as well. And thanks to all the social media, perspectives, that you are able to generate adequate demand and interest. But what happens is, the tough part is once you have to deal with the dealers, distributors, and you try to become omni-channel. That is where the challenge comes in. because India is this land of traders, distributors. Okay, we are gurus there as a whole community, most of it, right? So when you have to enter the retail segment, you ideally, I mean, if the person has that kind of experience, maybe that person will be able to navigate, or one has to be sharp enough to learn. Otherwise, you know, the brand can be eaten for lunch by any of these guys, and then will you be able to grow from there? And then, you know, whatever we hear, instances XYZ in the market about, you know, growing brands, come to play, because it's a tough market out there. To get your brand placed at the right level, you have to pay. To get your stock distributed, you have to pay. People may want you to do sales or returns. People may want you to have advisors or, you know, experts sitting at the store, which is again additional cost. So the room to make money reduces and to grow sustainability from there. So I would really respect those brands who understand this distribution plan and are able to grow from there. Because online can take you to a certain level, but we've learned from First Sky Lenskart that omni-channel is the play, and this is uniqueness to India. So copying US markets or others can help you to a certain extent, but then you have to have your way of doing business here. Also, if you're opening retail stores, etc., how are you managing real estate, rentals, and all the fixed costs? So these are the learnings, and if founders have that pedigree to experience and navigate that, I think there is a great market here. And to the point around minimalist and Mama's IPO, I think that shows the depth of the market again, that there is going to be exit opportunity. So that will further propel the whole cycle of investment, early stage, mid stage, growth stage, late stage, eventually to IPO or M&A. So that just validates, and these are two very good testimonies to the fact that the market is here to grow, and one should look at it, but with these learnings which I shared now. Yeah, thanks.
So I think a question to Daryl, while we're speaking about IPOs and specifically on Mamaearth and Ola Electric, while both of these companies did an IPO in like a less than 7 years span of time. So are VCs really, I think, patient enough to wait to see an IPO exit rather than take exits over the period and just go for an IPO exit? And how enthusiastic are you about that whole IPO stuff and the IPO buzz that's going on in India?
Yeah, I mean, I would say that it's certainly a very big positive, right? I think for India, we were speaking earlier with some members of this panel about how, you know, you hear about these companies doing the reverse flip back to India despite the cost. You know, obviously, I think the clear motivation being the domestic IPO. So I think that's been a very big driver of, you know, the positive development of the venture ecosystem, right? That we spoke about earlier. You know, with some of these companies, from inception to IPO, as you mentioned, 7 to 8 years, I think that bodes very well for how, you know, we see kind of the asset class developing deeper markets for exit. So I think very positive all around from how we would view it as an LP. I think there was also some discussion earlier on how VCs, you know, are holding on to companies for even longer, right? So with the advent of some GPs raising more opportunity or growth funds or continuation vehicles, I think increasingly as we see the market mature, I think these are all emerging as part of a fund manager's toolkit to create more value for both LPs, but frankly also the team, right? So I think this is, you know, a sign of maturity as, you know, in line with the theme of the market growing up.
Yeah, I think a valid point. Naganand, any views out there on the IPO side?
I think, you know, IPOs you're seeing more on the B2C companies. The B2B is a much longer gestation. There are some companies that are now coming back, like flipping again in the B2B segment as well. You know, some of the Axel portfolio companies are coming back. Look, exits are important, period, right? Because in India, you don't have a lot many M&As going on, particularly in the B2C space. There's no companies capable of acquiring B2B companies. So, and it's very hard for you to keep looking out to US all the time for exits. So that's been a hard question to ask for ourselves. And the fact that you're able to now list tech companies in India, I think it's a great thing to happen, because you have some visibility on how you can potentially exit than just saying either have to go list in the US IPO market, which is very, very hard, or say I'll get acquired all the time by a US company, which again is easier said than done. So this to me is a great way to get exits even for B2B companies.
Great. while we are on that question, I think one of the questions that I wanted to link was the exit that just happened for Bignify, where a private equity firm, Everstone, just bought it out. So from a SaaS perspective, are we seeing consolidation while all the AI buzz is going on? We read on, I think I saw somewhere on LinkedIn as well, where it was written SaaS RIP, it's rest in peace, because I think AI is just, I think the generational AI, Gen AI, and I think what the others are doing. Whether SaaS in itself is questionable, somebody was mentioning, I was discussing with Arun, whether SaaS Bhumi itself should rename itself. Why SaaS Bhumi? Because is it a SaaS Bhumi or is it something that's going along? So what's your take on that one? So two questions together. I think
you want me to answer that first?
Please,
yeah.
and then Subeer. Yeah.
Okay, so I think SaaS still remains, right? So people are calling it services as software now. So SaaS name still remains. It's just how you play it words. See, I think, look, AI is, everybody talks about it, early stages, because if you ask me, I'm still not sure which way things are going to go. Everybody is saying, let's invest in a few companies and learn from it. So we are still in the learning stage when it comes to investing in AI first companies. And if you look at many of the existing SaaS companies, they are also now trying to say how best to incorporate the new tech that is coming. The new tech that is coming is AI. And so you have to adapt your solution to whatever tech that exists. And then if you're over dependence on tech and not worried about the solution you're providing, there's a problem. So all of us honestly are discovering what to do in this current market, and things are changing at a furious pace. And there are a lot of reports that says many jobs will go away, but we have heard the stories before. I think we always have to take that with a pinch of salt. But disruption is coming. Amongst all the technologies that have come in the past 10 years, I think the language models have the most promise. Because you have seen lot of things come in, right? Blockchain was supposed to change the world. And then you said Web3 will change the world. So we have seen a lot of statements that change the world, but no doubt this is most promise. But how will it impact enterprise businesses is what the question that needs to be asked. I mean, as a user, an end user, you'll see a lot of applications that you can use, but there'll be some companies that will succeed. But if the technology to gain real traction, how can it impact enterprise businesses? I think that's the case, but there are still a lot of unanswered questions because of enterprises require, they can't go wrong. And current systems can go wrong. So there are a lot of things that still needs to be fixed. I think this is an evolving industry with a lot of promise. That's where I'll stop at this time.
So I think it's each person's definition, right? So for me, SaaS is not a sector, it's actually a revenue model. It's basically recurring revenue on a product that you are giving out to people. And therefore, the underlying AI is also a software technology. Nothing really changes. It's just the nature and the underlying form of the technology has changed. So I think not much is necessarily going to change. You're just going to see an underlying technology product that exists, and you're going to see different revenue models evolve on that. One of them is SaaS, which is a recurring revenue model. One of them could be outcome as a software service, which you pay on outcome. One of them could just be pure prosumer type of AI products, which are dime a dozen right now, which are, perplexities of the world. So I think it's just the underlying technology has changed. The revenue models will keep evolving over a period of time. You have to find the right target market for the right product and charge the customer for the value that you're offering. So in my opinion, nothing really changes on that front. It's just you have a new technology out there.
Right, but I think what's important is the new technology in itself, the interplay that it does is the conventional model, like one of the HR tech companies that we're working for. Because of the AI model itself, the HR tech company had to reignite and reinvent to come up with a new model in itself, like the outcome as a service that you rightly mentioned. You can't get restricted. So it's a very changing evolution in terms of how things are shaping up. So I think question to all the VCs again. Sector specific, if I talk sector specific, I think some of you have spoken in terms of where do you invest. So I think Sorin, over to you. Subeer, over to you. So how do you, is it your fund, is it very sector specific, is it deep tech, D2C, fintech, what is the choice that you make in terms of selecting a portfolio?
I think we are a sector agnostic firm as it stands. As it stands today, we just did our final close middle of last year. So we're still very young in our deployment stage. That said, we've got 6 investments in the portfolio already. 2 are in consumer, 2 are in enterprise, 2 are in financial services. So fairly agnostic in that. I think for us, the underlying commonality is great team and great business model. To my fellow panelists' point, I think D2C is here to stay. It's not going anywhere. It's going to keep growing over a period of time. It's a function of how you can reach that end customer, and it's a function of what price and what value you're offering to that end customer. While Meesho, for example, is a verticalized quote-unquote selling platform, the underlying people who are actually selling are just selling white label goods, and they're selling billions of dollars of white label goods. They may not have the wherewithal to make themselves a brand, a D2C brand, but they're selling product at the end of the day. And the reason that they're getting the traction that they're getting is because they have been able to reach a TG that wants to buy this at 200, 300, 400 rupees a product. D2C at a brand level is trying to sell at 1,000, 2,000 rupees a product. So I think there's a market for everything out there. It's a function of how do you reach that person, which is where I think the point on being able to be omni-channel and setting up stores is very important. So we have a company in our portfolio called Light Store, which basically provides retail as a service. They actually work with brands out there who may not have the experience to set up the offline stores or need help in setting up offline stores. And these guys actually do the entire workflow of it, right? They will go and negotiate the lease for you, find it for you, fit it out for you, hire the staff for you, run it for you, and get a service for the entire objective. And these are people who've been doing retail for the last 30, 40 years. So this is again innovation coming in at a point in time when pre-COVID, cost of customer acquisition was relatively cheap. Your return on ad spend could go as high as 5, 6 times. Today, post-COVID, your return on ad spend is down to 2 and 3 times, which is where omni-channel becomes very important. And therefore, you got to, you have the ability to create new business models to solve that same problem that has come up. So I think we're agnostic, we look at businesses that are trying to solve problems, and can those problems, those solutions be delivered at a value that is acceptable to the end customer. It's a very first principles thought process.
With that first principles, I come to a very valid question, because whenever clients approach us with term sheets, I think we hear this very common that the VC says that we are founder friendly or founder first. So what is this founder first and founder friendly? And I'll come to Sumit also on that, but from a VC perspective, Amish, how do you define what is founder first and founder friendly?
Yeah, good point, and quite debatable, as you said. But at least at Chiratae, I would say, why have we survived for 18 years today? There have been a lot of, history in India, and we've had like this scale, so many funds, because in some sense we have been that, right? At every stage of the founder's journey, we have a strong DNA that we map, like as a team, we sit together every quarter to think through the journey of a company and see where we have to nudge them. If it's growing well, support them. I'm talking of the high level and then go to micro. Help them raise money. If it's going even bigger, help them more. If it's looking at an M&A in some way, and it not necessarily be a stress sale. It could be a great company. Like we had a gaming company where we made 40 times return. After Series A, the company was sold, and a European player acquired it. And we ideated with them that, hey, at this juncture, you can raise more money if you want, but what is the ultimate destination you're looking for? And sit with them, brainstorm with them. So in a way, become partners to them. If the company is going south, okay, we again sit with the game and then tell them that what do you really want to do? If you're really passionate about the idea that you had, okay, if you wanted to survive, we will help you with, possibly an M&A. The idea will find a bigger home where they have the money and the resources to support GTM innovation. You may not be able to, but can we help you in that journey? And if in that case, if we have to compromise a bit on our returns, it's okay. We look at the company first, then the founder, and then look at, our interests. Of course, we have fiduciary duty towards our LP that we have to return, money to them in a multiplier effect. But if we keep fighting on each penny there, then we'll lose focus on the lens cards of the world, for example, A. Second, if we are fighting or, becoming harsh on the founder that, hey, I put 3 crores, I want my 3 crores back, then the reputation of the fund will go for a toss. No next founder will talk, because, negative news spreads faster. Tomorrow, if she has a bad experience, she will tell him that, hey, yaar, iske paas mat ja. So why create that? So, and hence it is essential for a fund to be founder friendly. Of course, if somebody is taking wrong actions or shortchanging us, then a lesson has to be taught. And there again, we have the fiduciary duty towards the ecosystem that we will take action, okay? Because we can't accept, wrong. But if the intent of the founder is fine, then we will be with them in the journey. If it means a little bit of compromise here and there, so be it. But we can't go against them. That's a philosophy at least we follow at Chiratae when we say founder friendly. Yeah.
Is it some kind of an hierarchy that founder first or founder friendly, or both are synonyms?
In a way, same, the mindset is let that idea grow in some way and, support the guy, because today we are here as enablers. We are not the innovators sitting doing there, right? We are just enabling capital and all the access we can, because we've been here in India for a long time. So support in terms of hiring, support in terms of strategy, GTM, anything in the whole journey, because these, like being for 18 years, again, we've seen all the ups and downs of the economy as well. So we know if there is panic time, we will not make the founder panic, hey, come on, do what? And especially, I think many funds here did that, right? Post-COVID or during COVID, immediately there were plans made that how do you save money, what do you do, and how do we support them, right? So that is how we have to act along with them and create more goodwill so that you grow further, right? Yeah.
Naganand, your take on that?
So I think he used the term support, right? I think that's what you need to do. Say founder friendly, all those things that are good names to use. But at the end of the day, what role are you playing in the growth of the company? I think that's the most important, and you have to know your place. Even more important, right? Because you are managing so many companies. You say I want to run the fund, and you should become an entrepreneur and not be an investor. So I think you should know your role really, really well, and focus on supporting and helping the entrepreneurs, and ensure that the governance is going well. I think because what happens is more often than not at a stage, at least we come in, founders really don't give a damn around governance, because they just want to get that first customer, do whatever it takes, and as a board, as an investor, your job is to ensure that this aspect is also being taken care of. So I think you need to understand your role as an investor very, very well and play it very well. And then whatever that means to the founder, because you have to put them and the company ahead of yourself and then do what is right.
Subeer, your takes, while I think you lead a lot of rounds, so how do you, because I think you come at Series A. So what's your take on the founder friendly and the founder first?
It doesn't change. I promise you, they do a lot of growth investing. They'll also tell you that even at a growth stage, it doesn't change. I think at the end of the day, the way at least I personally see it is, if an individual took a decision to quit his well-paying job or not so well-paying job to become an entrepreneur, in my eyes, that person is an alpha. And therefore, due respect has to be given. Whether you back that person, don't back that person, second order, because many times it may not just fit into the mandate of your fund. Many times it may be businesses that are great businesses for the entrepreneur to build, but not necessarily VC outcome businesses, right? So I don't think much changes in the context. I think you have to, once you've taken a decision to back people, as far as you're playing within the certain guardrails that you entered on, and there's always evolution in that relationship. As far as that is going through, there is always a situation where you will have disagreements. I think the test is how you come out of those disagreements, and that makes it even stronger eventually.
So I think, Sumit, over to you. From a legal perspective, how do you term, I think, a founder-friendly term sheet?
I think my co-panelists here have explained what founder-friendly really, in essence, means, which is sometimes when we are doing the diligence or negotiating the transaction documents, I think it's misunderstood to maybe from a founder's perspective, it's misunderstood to believe that you let go of some of the key governance and compliance-related aspects. Which is not the case. Just to, I think, to contextualize it in the sort of VC transaction, how does this fit in? Is when most funds that we work with, and we've generally seen in our experience, is that when they're coming in at a early stage, at a seed round, or even Series A to a certain extent. Your approach towards compliance and governance is that, okay, founders just set up the company, the focus is on innovation and growth and various other factors, and maybe compliance and governance is not the focus area at that point in time. So you're okay to, sort of let go of some of those things at an early stage. Of course, you get some of the key compliances done, and that's why you have a fairly elaborate list of conditions precedent, as we call it. But you would see that in an early stage, a lot of the compliance and governance related issues are pushed to conditions subsequent. And the idea is that, okay, once the investment has happened, and you have some amount of capital, you invest some more, some time and energy into also getting the governance right. Which I think that point gets lost over a period of time, because once the investment has happened and life has gone back to normal, and then you're again back to driving growth and innovation. When later funding rounds happen, I think some of those conditions subsequent become ticking time bombs, they become sticky issues, because the diligence for a subsequent round starts with a check on whether those conditions subsequent have been fulfilled or not, what's the status on those. And unfortunately, in a majority of the transactions, you'd see that they've not really much has been done about those conditions subsequent. And that's when you start reinventing the wheel, you start digging deeper, the diligence becomes a long run process. There is some amount of resistance on why the diligence is taking so much time, why things are being looked at so deeply. And the discussion sort of becomes a little, in certain situations, becomes a little hostile and unfriendly. And I think that's where people start believing that why are you not being founder friendly? But I think as we mature and get into senior funding rounds, some of these things really need to be looked at, and I think my suggestion, and at least some of the companies, startups that I work with and I advise, I constantly keep telling them that let's focus on the conditions subsequent, let's get the governance right, let's get the compliance in place, so that when we are doing subsequent funding rounds, we are not really going through these uncomfortable conversations on why some of these things have not been done.
So I think, Mahima, a question to you. While I think most of the people out there are VC investors, while you pick a startup that you want to maybe partner with for a marketing deal, because it's not pure investment, it's a marketing deal, come an investment. So what do you look at? What are the kind of diligences that you carry out while you select a particular venture that you want to do a marketing deal with?
I think first and foremost, we see if there is a media fitment with the media that we offer as part of our deal. The first thing that we see is if there is a media fitment, whether the company would benefit from the media, would use it, because at the end of the day, we want to partner with those companies that end up using our media. We look at consumer focused companies, of course. Companies, we were early stage partners in the Zomato and the Flipkarts of the world. So basically what we're trying to do is pick companies that require some amount of trust building, some amount of brand building, because there's only so much that performance marketing can take you. There's only so far that it can take you. So there's a lot more companies that require that trust, the brand building, jewelry companies or nutraceutical companies. The trust element, I think that's what we look at when we pick companies.
Daryl, over to you. One question, and then I'll put up last one question to all the panel, but just before that, while we've seen the last decade prior to this one, where Tiger Global was the primary driving factor of a lot of investments happening on the India side, I think what's changing over the period, do you see, because of the interest rates that are going to obviously cool down over the period, that trend coming back, or it's going to be predominantly domestic funds that are going to drive the Indian VC space out there? How do you look at that?
I think we saw some statistics on the slides before this panel, right, which I guess showed kind of the increased activity of the domestic funds. Right, I think over the years, I think what has really been positive is that it used to be the global franchises in India that had the capital, the deeper pockets to support companies kind of through the life cycle. And I think as you've seen the market develop and more funds get more established, build credible track records, raise fund after fund after fund, they are able to kind of, be able to deploy more deeply into the market. And I think that is very positive. I mean, in such a long-term asset class as venture, I would hesitate to say kind of, I guess the question, that really matters isn't really, is it global or domestic funds? I think overall it's a healthy ecosystem that is developing, right? I think I frequently, and I follow the Indian news as well as I can, sitting from outside of India, I frequently read about, companies that raise rounds that are, relatively high profile, get led by domestic funds, and sometimes the globals are kind of following that round, right, or so to speak, right? So I think there is, a good crop of VCs that are emerging that, have a right to win in specific sectors or teams that they are kind of pursuing, and no, I think this is overall very positive. Selfishly from an LP perspective, right? Having more kind of compelling investment talent to back is always good for us trying to build a diversified portfolio.
Thank you. And I think I'll put up the last question to all the panel. While I think we've been speaking about IPO exits and all of these things, while I think all the VCs and I think your marketing tie-ups also, while the investments is going on in the company, VCs look at obviously from an exit perspective that IPO is good. That's an ultimate exit. Like it's there in all term sheets, is there in the SHAs, that it could be an idealistic scenario that can arise. But is this whole thing about the rush of going to an IPO, is it really impacting two things? One, obviously the businesses that startups are building are disruptive in nature. Is it kind of compromising that thesis of being disruptive, being innovative, bringing something on the table, or also multiple other things that a startup could do? Obviously there could be a company that could grow large in size even without IPO, or could have multiple exit other opportunities. So do you think there is some negative to this IPO, or it's a great thing that companies should aspire for? I think we'll start with Amish, and then Naganand can add to that.
Very interesting, like can it be negative? Right, very good point of view. I think the biggest thing that I feel for an IPO, and slightly different answer here, is the impact on the life of a founder is the biggest thing. It's his decision, honestly, what he wants to do. Because once you are listed, it's a game-changing thing. Of course, when you are funded by VCs and PEs, also you have to show performance, growth every quarter, okay? And then that soft element of founder-friendly comes in when VCs and PEs are there. But capital markets, I don't think so, okay? And that is where the game-changing event for that happens. We've seen a lot of companies, which the new age companies, the first set of new age companies, when they got listed, they had to be trained about, communication with the markets. Anything you do, you have to speak. Why, how, when, what impact, right? And if you don't, what happens to your stock, okay? And share price up and down, ideally should not matter, but it can start mattering you, and your sleepless nights start then. So the biggest impact is for the founder and his journey. Now, couple of ways in which IPO, I mean, of course, everybody knows in the room, but it's not just for the benefit of that VCs or PEs will get exit. That is one of the ways. There are other ways we can get exit. And thanks to people like HarbourVest now, there's a lot of secondary also happening, okay? As a new animal which is now emerging in the market, secondary deals, right? Which India has not seen too much in the past. M&A, as Sir rightly said, it's slow, but maybe once the global markets pick up, they will. But IPOs become a permanent source of capital for the founder, especially in those domains where they need capital. Second is where the brand gets a lot of trust and visibility in the global markets. That is a big thing, when, hey, I'm a listed company, that adds a lot of credibility that, hey, you are here to stay and you're here to stay forever. Unlike a thought that, this company will come and fly by night and tomorrow it will be out of operation. So that trust is a big thing. And third, it enhances the overall experience for investors. Today, every common man is putting that 1,000 rupee per month in SIP, right? The opportunities to invest are less, and hence whatever heat we saw. So as the scope of, good companies increases, more and more listed companies are here, there is more money to be made, more depth, more global capital to be attracted. So it's a great cycle, I think. Of course, there will be those times of being hot, being cold, being hot, being cold. But over a longer journey, this is certainly very beneficial, and we would support our companies in that journey. But of course, they have to think of it the right time. Some people think, oh, it's hot and let's do it quickly and get a right valuation. As I said, I started by the hypothesis, it's something different for the journey of a founder. We may exit at certain valuation, whatnot, but what about that? So, if somebody is just rushing for the
valuation point of view or that, maybe that is short term. That should not be the thought process, I would say. Yeah, thanks.
So my thought is keep the philosophy simple, right? I think the base is you have to keep building a good company. And there are a lot of opportunities that come along the way. And be aware and grab whatever opportunity is best at that point of time. It's very hard to predict sitting today, 5 years down the road, what's going to happen. The only thing you know is you have to keep building a good company. Like, 3 years ago, you could raise a lot of money in the market. Today, it's very hard to raise a lot of money in say, private markets. Nobody is doing, 500K, 500 million deals, not that much. But IPO is hot. 3 years down the road, IPOs might cool down, but again, raising capital in private markets might get better. So it's very hard to predict. Yeah.
So no predetermined notions, basically.
Yeah, just keep building a good company and grab opportunities that come in. The same question, you won't like, if you have an offer to exit and an offer to raise the next round of capital, what would you do? I mean, you can only base a decision based on what you know today. I mean, in hindsight, everything will look hunky-dory or whatever, but you got to grab opportunities that come by your way.
Shabir, your thoughts?
So I think your question was IPO versus slowdown in innovation post-IPO. I think I'll break it up in two parts. First and foremost, I think an IPO is not the be-all and end-all. It is an event in the life of a company, right? It is a liquidity event as far as private investors are concerned, but it is an event in the life of a company. The second part of your question being, does innovation slow down? Slightly technical answer to that. See, at the end of the day, whether it is when you're going IPO, you're catering to capital that has been allocated by people who are looking for a return profile from capital markets. When you're doing seed investing on the other end, it is capital that's been allocated, which is far more riskier capital. And therefore, what people in public markets are looking for is companies that can deliver predictable 30% year-on-year growth with profitability. That is what they are looking for. So you as a product or as an entrepreneur, you're catering to your customer when you're selling things. At the capital market side, as an entrepreneur, you're catering to the market that your shareholder is. When you are younger, you're solving for disruption because you need to move very fast. When you're at the capital market stage, you're catering for predictable revenue, predictable profitability. That potentially can result in a slowdown in innovation. But that said, when you're navigating such a large ship, I think there are enough areas where innovation can be created while maintaining 30%, 40% year-on-year growth. And we see that. There's enough of it going on. So I don't know if I answered your question, but it's not a direct...
Agree. I think numbers will be a driving factor. The EBITDA, the PE multiples, I think that comes into play. I think the bottom line is very, very important. I think Amish also put it rightly that how a founder reaction could change the stock market pricing. We've seen with Ola also what happened 3 months back. So we know that how things can shape up. So I think, we'll end our session out here. Before we depart, I think any questions for the panel?
Given that we've heard a lot from VCs and advisory firms, we thought we should also listen to a startup founder's perspective before we go on to the Q&A. We invite on stage Ramkumar RS from Milligold, a fintech startup focused on gold-based savings. He is essentially looking for feedback from the entire panel, and also any on-spot funding will be welcome as well.
Good evening. I want to start with, before I start the slide, I have 5 minutes, so I promise you that I'll finish it in 5 minutes, even though it looks like a long story. For 99% of Indians, gold is not an investment. I bought a necklace for my wife many years ago for 30,000 rupees. Today it's worth 6 lakhs. I don't sell it and book profits. And God forbid there is a health emergency in my family, I still won't sell it. I'll pledge it and pay interest. The reason why we buy jewelry for our wife, for our spouse, for our partner, for our children, for our grandchildren, is because we love them. That is the reason why I believe that there is an opportunity to build a $100 billion AUM business in India alone for gold-based savings and gold-backed lending. So for me, the measure of success in this business over the next 20 years is what percentage of my customers invested in my IPO. And in case we decide to give a strategic exit to our investors earlier, I would want to be a brand worthy of being acquired by Tata Group as Tata Milligold. So you might have heard about some of these articles in the Ken that has come in the last few weeks about what happens when you do growth first business instead of a brand first business. Okay, so you can look it up later if you want. But Milligold is not a digital gold company. We don't associate ourselves with the digital gold industry because we buy and store the gold, customers' money. We don't keep it as money, we don't rotate it, we don't lend it. We buy it and store it as gold bars in the MCX exchange in Ahmedabad. It's a SEBI approved exchange. So when a person is saving for his wife's jewelry, which is to be bought after 5 years, or for his daughter's marriage 20 years later, or he is depositing his gold jewelry with us as an FD, to be returned as FD, which is like a discontinued sovereign gold bond of the government, or when he is borrowing for his MSME business, I think the brand is the most important thing, not anything else. So the emotional connect with the brand the customer has, the authenticity, the transparency, and all that derives from the values and beliefs of the founders and management. That's why we call ourselves a brand first company. We all know about a product first company. When we talk in person, I will tell who it is if you don't know, who had to burn $60 million in capital to get a 14 million ARR business. And that too after pivoting away from savings into e-commerce. We can build a 500 crore ARR in savings alone with just 50 crore capital because of our brand first approach. We will show you how when we meet. The digital gold business, which is a very, very low ARPU business, the AUM per user is extremely low. And when we focus vertically on the jewelry use case, the savings and lending, the ticket size goes up by about 20 times. And most importantly, jewelry has emotions and family values, which means that you can build a brand, not just a transactional app. So we already do about 25 lakhs GMV on the savings business, purely through word of mouth. We just started about 50,000 rupees worth of performance marketing in the last 1 or 2 months. We want to launch a buy now, pay later product. It doesn't exist in the market sufficiently. So huge potential for a buy now, pay later in the jewelry market, which is typical turners of about 3 years. We want to do an alternative replacement for what the government has discontinued, which is a very popular product, but the government has discontinued. But we want to offer the same thing, gold in return for gold with 2.5% per year interest. And we also want to do an MSME credit product, which is an interest-only, no EMI product, where the MSME owner can leverage his family jewelry and keep it like with us, but with the flexibility to check in and check out individual pieces of jewelry for family functions. Okay, so this will make this is a huge, huge market by itself. So as a brand, we want to focus on both the savings and the lending side. This is a huge TAM, so I don't want to talk about it. But our initial focus is the urban working couple earning 1 lakh per month. We just need 50,000 customers saving 1 gram per month to get to 500 crore ARR. Just 50,000 customers saving 1 gram per month will give us 500 crore ARR. And that too urban working couple acquired through digital marketing only. So I have 35 years of experience in marketing, out of which 20 years has been as an independent consultant. I spent 10 years in a Murugappa Group run school and college, and 15 years in Murugappa Electronics, Murugappa Group Electronics Division. And I imbibed a lot of their values and beliefs, most important of which, cash is king and profitability is important. My co-founders Deepak and Rahul has been able to build and maintain this Milligold platform with zero cash burn. Okay? And this platform can scale up to 1 million customers without any further investment on the tech platform. We don't have to pay hundreds of employee salaries to build a tech platform. And we have some very strong advisory support on compliance, control, and risk. I believe hunger to win at any cost is different from the passion to make a difference. If you think there is a difference between the hunger and passion, let's talk. I'm a poet, published philosopher, Bharatanatyam student, and I recently wrote and written and directed a play in the Short and Sweet Festival in Chennai. I write opinion articles frequently for Your Story in India and Goodman Project in the US. I also am a second-time entrepreneur. I used to run a company called Mango DVM in the music space between 2007 and 2012. We are doing three, one is done, two is under production, 35,000 rupees each, 3 ad films. A brand agency is quoting us 7 lakhs for just one ad film. Okay? So we have done it for 35,000 rupees. You can see this ad film, no compromise on production quality. We have spent 50,000 rupees on Meta, got some very good traction just for 50,000 rupees in terms of views and interactions. You see what we have got for 50,000 rupees. Because we are telling a story. We are selling, there is emotion in it. Okay? The industry margins for saving and lending is 5 to 10%. But if our brand is strong, we can do better. Even if we get the same margins, our cost will be much lower because we think brand is more important. Thank you. Any questions from the audience?
Where will you buy the gold from and where will you keep it when I start investing?
Okay, so we are the only gold saving company in India to buy as well as store the gold bars, physical gold bars, in the SEBI approved M6 exchange in Ahmedabad. Till the day you need it to make jewelry. So on the rate of making jewelry, we will transfer it to the jewelry shop either as gold or as money.
Which jewelry shop?
Any jewelry shop in India which accepts digital payments.
Which accepts digital payments. So
Yes.
you will make a payment to them.
Yes. Or to, yes. Basically, we can settle to any jewelry shop in India which accepts digital payment at the same price on which the jewelry is being bought.
But if I want the gold only, the bar, will you give it to me?
I can do door delivery for your home address in the form of bars and coins. I can also do bank settlement if you want to sell it and use it for some other purpose other than jewelry. So we have multiple options in terms of redemption.
And who are you buying your gold from?
We buy it in the M6 exchange platform. So it's a commodity exchange. So you buy it in the platform. There are buyers and sellers are matched there in the platform. And the delivery happens in the warehouse. And we get a GST invoice from the seller.
But let's say first, all of us buy 1 gram. Okay, so we end up with, let's say, just 10 grams on day 1 and 20 on day 2. And I want to withdraw. I want my 2 gram back. Will you be able to do that?
Yeah, normally on a day-to-day basis, our sales minus redemptions is what we buy in the MCX. But if the redemptions are more than the sales, we sell it in the MCX. So MCX market is open till 11:30 p.m. in the night.
We get physical deliveries after that.
The delivery will happen in the warehouse at the M6 exchange in Ahmedabad. You don't have to physically, of course we can go there and physically take it, but it remains in the M6 exchange controlled warehouse with like a demat account, there is a warehouse account. So it is there. So you get a bank statement, kind of a statement saying that these are the bar serial numbers that we own. Thank you. Thank you very much.
We can have questions from the audience now.
Hi, good afternoon. This is Anshu from Zito Incubation. My question to you, Amish, is you just mentioned that you turned into an adult, so you are more familiar with the red flags, right? So I would like to know what were your bad investments in your investment journey, which made you to turn away from the investments in the startups.
Can you clarify better? Sorry.
Can you hear me?
Yeah, I can hear, but can you clarify this?
Yeah. So in your investment journey, which were the bad investments which made you realize that those were the red flags, which if you would have knew it earlier, you would have either not invested or you would have made a better strategy, for the investments in the up rounds and other rounds.
So there are two parts. One is mistakes, and mistakes could be 2 points. One is anti-portfolio, where you rejected an idea, it was worth it. Second is where you invested and you learned, yeah, this is something which you should not have done in general, just to make money, okay? But the other part is corporate governance, which I think was covered by my colleague here. Like we had one instance where there was a fraud by the founder, right? And then it was a write-off for us and a big shocker for the industry also. And such instances have happened quite a few in the last couple of years, right? So that's where the learning is, stricter corporate governance and more measuring the performance, in a more diligent manner. What happens with VCs is they are hypothesis driven, as against growth investors who are more data driven along with hypothesis. At early stage, you are just backing a person, an idea, right? Sometimes even the product is not ready. So at that stage, the ability to gauge the intent or the quality of a person is the challenge, which is a very soft element. There's no right formula. You may like somebody and at some point the guy's intent changes, then you can't control it. So that is the tough part. But what as a VC we can do, and as Subeer also mentioned, here we are backing that kind of person, in the first place. In VC, what happens is two parts of investment. One is the hypothesis, what area you want to go in. Like as I said, vertical commerce first and lens card. There was a thesis that this is the domain we want to go in. And then we are generally backing the person. So if we go wrong there, that will be only with a period of time, of investing. And as you rightly said, 18-year journey. So over a period, of course, we'll still make mistakes, but at least we sit together and determine, and every Friday as a team we sit, even like we are doing new investment through a new fund right now. So every Friday we sit and discuss that, hey, this was the idea which came, we decided to drop it, and we track whether this company doing well, did he get any other investor to fund them, what did we miss out, and if you have invested in someone, what is happening? So we're discussing that. So as a group, because a lot of youngsters also join from IITs and stuff, right? So everybody has to learn, because eventually everybody has to take that gut call of backing that person. So this is where the red flags can discuss, some of the examples to your specific point that we try to look for, okay? And again, it's not a hard cast rule, but typically when a startup is happening, we try to see if there are 2 or 3 founders. One of the learnings. Is it a single founder? Then there is too much of dependency. Now recently we rejected one idea which had 2 founders, but we realized that there was nobody who was really the tech guy. In a VC back, like we back tech disrupted ideas only, that's our core. So if there's no CTO material or no tech material, then how will innovation happen at that stage? Everybody will come up with great idea, but who will execute the idea in that real fashion? So these are some of the learnings which have come over a journey, and we use that very diligently in every investment process. The way investment decision happen, that every member in the team has 1 vote or half vote, depending on their seniority in the system. And that's how a democratic decision happens whenever any investment happens, either a fresh or a new round. So we try some of these learnings which I'm sharing, but a lot more. Maybe we can have a one-on-one later. Yeah, thanks.
Hi, my name is Aditya Sesh, and I have a question to all the venture capitalists here. The data shows that Karnataka still leads in terms of venture capital investments, but there are other emerging centers like Maharashtra and Uttar Pradesh. To be noted is that both these economies are moving very quickly towards $1 trillion mark. My question to venture capital is, how much of political will plays in the emergence of new startup or venture capital destinations?
So I think the creation of the environment is where the political will is required, right? Because to do a startup, you need talent and capital. And why will talent and capital come to a particular location? Because it's just not, one thing. It depends on the entire, like there's good schooling system, good place to hang around, good hospitals, good environment to live. Do I feel happy living in the place? So I think where the political will comes is creating this environment, because this cannot be created by entrepreneurs or by investors. So once you create that environment, then it'll become, a self-fulfilling prophecy after that, right? Because then you have, create the momentum and the virtuous cycle takes over. So the political will is very important there. You create that and you move away so that then
other people